Hello everyone, welcome to Yadnya Investment Academy. Equity Linked Savings Scheme, that is ELSS, also known as Tax Saving Mutual Funds, are becoming preferred choice for Section 80C investments for many investors. This trend is majorly due to exceptional returns by ELSS in last few years, least lock-in period among all Section 80C investments, and it also enjoys triple E status, which means all the returns earned are completely tax-free too, unlike tax saving FDs or NSC, where interest earned are not tax-free. With all these benefits, we should also understand that ELSS are also the riskiest Section 80C investment option and therefore should be treated differently while investing. In this video, we will discuss 7 common mistakes we make while investing in ELSS. These mistakes are unique to ELSS investments and are not relevant for other Section 80C investments. First mistake is investing late in the year or investing a lump sum amount in ELSS. Have you completed your Section 80C rupees 1.5 lakh tax saving investments as of today? I am sure many of us still haven't. Data shows nearly 50% of total inflows into the ELSS category happen in the last 3 months of the financial year, that is January, February and March. March alone contributes to around 22 to 25% of total inflows. So most of us invest in ELSS in last few months of the financial year when the time for showing proof of tax saving investments is upon us. This is a very poor strategy, especially with a product like ELSS, which is dependent on stock market performance. First, this strategy could lead to money problem at the end of the year. The second problem is that it forces you to invest a lump sum amount. This creates a big risk of market timing. Let's understand this with an example. Here is a chart of benchmark Sensex monthly performance of last 5 years. We have considered the highest touching point of Sensex in that month. So in April 2012, Sensex touched highest 17,664. So we have taken that number here. Similarly for all others. Now when we look closely at this chart and consider our habit of investing in ELSS in last 3 months, we will understand what we are losing. So if we would have invested in February-March 2013 in ELSS for financial year 12-13, we would have invested at approximately 20,000 index and would have missed the months where it was less than 18,000. So more than 10% return loss. Similarly, if we would have invested in February-March 2014 for financial year 13-14, we would have missed the dips of April and August 2013. Now taking the case of 2014-15 financial year, our last month's investments would have meant investing in market peak. Similarly, if we are considering investing in February-March 2017, we have already missed the dip of December 2017. So hope you have understood how your last minute investments in ELSS is eroding your returns. And therefore we always advise investing in ELSS through systematic way, that is SIP or STP. Another commonly observed mistake is that investors put their money in a new ELSS funds every year or invest 4 to 5 ELSS funds together. Due to this, they end up accumulating a large number of ELSS funds. This causes excessive diversification and results in a cumbersome portfolio that becomes hard to monitor. Due to this, during portfolio review, it becomes a challenge to understand which fund has performed well and which has not. Of all the tax saving products, ELSS funds offer the shortest lock-in period of only 3 years. In other products, the lock-in varies from 5 to 15 years. One mistake that many of us make is to redeem the money as soon as the 3-year lock-in period ends. This is another blunder. ELSS should be considered as any other equity mutual fund investment where recommended investment horizon should be minimum 5 to 7 years. Ideally, you should redeem your ELSS investments only when you have achieved your tagged financial goal or overachieved your equity allocation. Do you choose the dividend option while investing in ELSS? Many of us invest in dividend payout option thinking that we will at least get some gains out of our investments even if the markets are down. Dividend payout option reduces the benefit of compounding significantly, and the money we get as dividend keeps lying in our bank and hardly gets reinvested. You should always choose growth option while investing in ELSS as it gives the best tax benefit and give maximum compounding benefit. Also remember that dividend reinvestment option is even worse. Every time the fund gives out a dividend and reinvests that dividend into your account, the 3-year lock-in period starts all over again. The fifth mistake we do is that while selecting the ELSS fund, we bet on short-term performers. The funds that are topping the charts in past few months may not be the best choice for you. Instead, you should focus on funds that have a track record of consistency. To select a consistent fund, compare the fund's performance with that of its category and benchmark year-wise for the last 5 or 7 years. This is a good measure for capturing consistency. Sixth common mistake we do is that we do not understand the nature of ELSS fund we have selected. Though ELSS is considered as a separate category and all funds are compared with each other, but it is not entirely fair as some of these funds are more large cap oriented while others are more mid and small cap oriented. As we know, the large cap oriented funds would be less volatile and hence less risky than the mid and small cap oriented funds. If you invest just by looking at the returns of the funds in this category without taking into account the nature of the underlying portfolio, you could end up with a fund whose risk profile is at variance with your risk appetite. Here is a chart which was published recently in Economic Times which can help you decide your pick. Conservatives are the ones which primarily invest in large cap companies and hence are less volatile and less risky, and aggressive ones are those which invest primarily in small and mid caps, whereas balanced gives you best of both. Last but maybe the most common mistake is that we invest in ELSS only for tax saving. ELSS are equity schemes which provide the benefit of capital appreciation in the long run. ELSS investments should be done with a long-term financial goal in the mind, such as child education or retirement, etc. And accordingly, the allocation and investment horizon should be considered. If managed well, ELSS are one of the best investments you can do. Many advisors recommend investing in ELSS funds even if their client's Section 80C's 1.5 lakh limit has reached, because due to 3 years lock-in, the fund managers of these funds can take long-term stock bets and give you even better returns than many other open-ended equity schemes. If you want to fully reap the benefit of your ELSS investments and get the maximum returns, it is very important you avoid all these mistakes. If not, you are better off investing in safer investments such as PPF and other instruments. That is all on this topic. If you have any question, please do write in the comment section below and have a great day ahead.